This year, we have shifted the way that we are doing these things. You both are going to be timekeepers for each other. Manish, you will keep time for Lee, who has 15 minutes to do his presentation. And Lee, Manish will do his discussion presentation immediately after you, and he will have 10 minutes. And so please flag off when each other of you runs out of time. Does that work, Manish? So you're timekeeper for Lee, and Lee, you're timekeeper for Manish, and then we've got 10 minutes for the floor discussion. Is that okay?
Yeah,
That will
perfectly
work.
fine.
Great. Without further ado, Lee, may I invite you to start your presentation?
Thanks for having me in the conference. When I submitted the paper 6 months ago, I really wish I can visit India. Unfortunately, the virus do not cooperate, so I end up stuck in here. Before I get started, I have to warn you, this is way past my bedtime, so during the presentation, I'm starting to look silly, don't know what I'm talking about. Please forgive me. The paper I'm presenting are titled China's No-bailout Reform, Impact on Bond Yield and Rating Standards. A very quick background about the paper. Okay, now if you look at the Chinese bond market, it has been growing very fast over the last two or three decades, like everything else in China. And by today, it's the second largest in the world. Okay, now one thing very peculiar about Chinese bond market is that over 90% of the bonds are rated AA minus. In comparison, in the US, less than 10% of the bonds would be rated about a AA minus, and in the US, there's only like 4 AAA companies. Okay? In China, we have hundreds of AAA companies. And an observer was struck by this huge percentage of bonds rated so high, and the critique is that the Chinese rating agencies are inflating the ratings significantly. Okay? No international rating agency can rate Chinese bond. So all the rating agencies are domestic rating agencies. And in our paper, we laid out some of the institutional details of why Chinese rating agencies are more prone to rating inflation. There are other line of argument making the argument that the high ratings in Chinese bond market are justified by the fact that there had been no domestic bond default prior to 2014. Okay, there's a reason that there's no default prior to 2014, even though the bond market is huge, is that Chinese government, okay, consistently bail out any potential default. Okay, Lixin and Melhout 2017 lays out several arguments why the Chinese government want to bail out any potential default. But the overarching reason they want to do it is they want to foster the growth of the market, because Chinese investors are not familiar with credit risk. So they want more investors to participate in the market and shield them from credit risk. Okay, now when you're shielded from credit risk, one of the bad consequences is that investor basically says, who cares about default risk, right? There's no default. I don't think they're going to have default. So I'm going to ignore the default risk completely, and bonds of different risks priced very similarly, okay? And people ignore the default risk. Now, we know that cannot be continued, okay? At some point, the government have to do something about that, okay? Trying to resolve the moral hazard problem, okay? So what happened then in 2014 and 2015, China's government basically says, wait a second, I'm not going to bail out everything, okay? And we want the market to play a larger role. So in 2014, the first the state-owned enterprises defaulted the bond, and in the following year, a state-owned enterprises, SOE, default on the bond as well. Okay, so those two defaults signal the Chinese government's kind of the policy shift, okay, in terms of the bailout. Okay, and what we're doing in this paper are basically say, hey, look, what's the impact of that the reform policy and the bond pricing, as well as credit rating standards. Okay, before we get into our findings, stuff like that, kind of like to give you pretty a quick look at how the default evolved over the last couple of years. Okay, so again, the first default happened in 2014. The first state-owned enterprise default happened in 2015, and in the following 4 years, the number of default just goes through the roof, as well as the par value of default increased significantly. And one table in our paper that looks at the number of defaults as well as amount of default between state-owned enterprises and private sectors. Okay, so if you look at here, about 80% of the default happen, okay, to non-state-owned enterprises versus state-owned enterprises owned by both the central government and local government, kind of for about 10% of all the default. It's not that the market is dominated by non-state-owned enterprises. Okay, indeed, if you look at all the new issues of bonds in China, 80% of them are issued by state-owned enterprises, but they only account for less than 10% of the default. So even though the government does let state-owned enterprises default in 2015, we do have evidence that the government are still supporting state-owned enterprises versus the non-state-owned enterprises. They basically let them go, but they still keep on helping the state-owned enterprises, even though selectively. It has some implication to our finding a little bit later. Okay, so the first thing we're going to look at in this case is say, hey, look, when the government removes implicit guarantee, what should happen to the rating agencies, right? What should a rating agency respond? How the rating agency should respond to the removal of implicit government guarantee? Well, the first intuition is that the rating agency should tighten their rating standards and lower the rating, okay, across the board, right? Because the default risk becomes more credible. Alternatively, we'll say, wait a second, hold on. If the government implicit guarantee is removed, chances that investors are going to be more careful about credit risk, and they'll be going to pay more attention to the ratings, and that going to increase the yield spread between highly rated and lower rated bonds. That in turn will push, okay, the rating agency to inflate the rating even further, right? So if there's reason that there's a rating inflation, the rating agency catering to the demand for high ratings, the removal of government implicit guarantee may actually put more pressure on the rating agencies to cater into the demand for high ratings. So the alternative hypothesis is that the rating agencies actually loosen their rating standards and assign a higher proportion of bonds of the AAA rating. So that's our first kind of like hypothesis, okay? The next hypothesis we look at is say, well, how investors would respond to the removal of implicit guarantee, the government guarantee, right? So again, the first reaction is that the yield spread between lower risk and high risk bond must be widening, okay? Because again, ratings become because default risk becomes more credible. Okay, the other alternative hypothesis is that wait a second, okay, the market may not react to it, because the Chinese government has been repeatedly warning the market that they are going to be not bail out every default. You guys need to be careful with the credit risk, stuff like that. So we say, well, maybe the case that the message has already been well broadcasted and investors already taking that into consideration. So that the policy change or the first default are not going to make much difference. Okay, so that's our alternative hypothesis. Okay. Very quickly, we look at how do we test. Okay, so the first hypothesis, we basically built a simple model of ratings, okay, using a bunch of issuer characteristics and using a dummy variable, okay, for equal to 1 for the bond issued after 2014. And if the rating standard does change, then the coefficient and the post dummy is going to be significant. Okay, so rating variables range from 1 to AAA to 4 to A minus. So if a negative significant beta 1 for post, okay, indicating that rating standard will become loosened. On the other hand, a positive beta means the rating standard going to tighten, or in other words, ratings, everything equal, ratings get lower. So I'm not going to get into details on the sample, but quickly we're looking at the regression results. First, we look at all those firm characteristics that have been documented as a major determinant of ratings. They all show up as expected, what we expected. Okay, so this is really the variable that's of interest. Okay, post what happens to the rating standard after 2014. It comes up negative. Okay, the p-value is marginally significant. Then we say, hey, look, between the two hypotheses, if the rating agency tightens their rating standards immediately after the removal of implicit covenant guarantee, we expect the effect to be show up immediately, right after 2014. On the other hand, if the alternative hypothesis says that the investors put more pressure on the rating agencies to change the rating standards, we expect those effects to be showing up gradually over time, because it takes some time for investors to put in pressure on the rating agency. Okay, so we changed the dummy variable from post dummy variable to a series of year dummies, and indeed what we see here is that for the first couple of years of the 2014, rating standard did not really change, only changes starting in 2017 and gradually getting looser and looser over time. So that's kind of like consistent with our hypothesis, second hypothesis, that rating the investor putting more pressure on the rating agencies to change their rating standard, loosen their rating standard. On the second part, we were looking at yield spread, okay, between the lower rated and high rated bonds. And again, one hypothesis says that the credit spread should increase, and the hypothesis said not change. So over here, we did two things. One is that we're looking at changes in yield on outstanding bond around a shorter event window, okay, around that first default event, okay. The second thing we did is look at a much longer window. Instead of changes in the yield on outstanding bonds, we're looking at the changes in the offering yield on newly issued bonds prior and after the first bond event, looking at a much longer event window. Very quickly, what we find is that the results are consistent with whether we look at outstanding bond or the newly issued bond. What happens is that very clearly that yield all goes up, okay, whether we are AAA rated or A minus, AA rated. But the yield increase are much more for lower rated bonds, okay, increasing the yield spread between AAA and AA minus rated bonds. So that is from the outstanding bond part. Also, one more thing, when we separate the sample between non-SOE bonds and SOE bond, the effect are much more salient for the state-owned, non-state-owned enterprises bond. For the state-owned enterprises bond, the effect only shows up basically on the lowest rated bonds. Okay. Similarly, when we're looking at newly issued bonds offering yield, we see pretty much the same pattern. Okay, lower rated bonds, yield goes up quite a lot. On the other extreme, when we look at AAA rated bonds, yield actually goes down. Whether we argue that this is a kind of flight to quality effect. Okay? And we run a regression as well. Again, regression results kind of consistent with the idea that the yield spread between AAA rated and lower rated bonds widens significantly after the first default event or the changes in the policy. And another interesting thing find is that there's a yield difference between state-owned enterprises bonds and non-state-owned enterprises bond widens quite a bit, okay, after the 2014 reform effect. Okay, the reason again is that the Chinese government continued to support its state sectors, okay, versus the private sector. They basically let them to swim and survive on their own. Therefore, it creates an even larger advantage for the state-owned enterprises to raise money in the capital market. So for the sake of time, I know I want to have a couple of seconds left. we also look at a difference in different analysis. But in conclusion, we look at this reform policy. We argue that there's good news and bad news. Okay, good news is that indeed, when the threat of default becomes credible, okay, investors pay more attention, and the reform measure enhances credit risk-based bond pricing and enhances capital allocation. The bad news is that the reform is not complete. The reform is not complete. Okay, the continued government support for the state sector exacerbates the funding disadvantage for the more productive and more profitable private sectors in the bond market. And at the same time, the structural problem with the Chinese rating industry makes it that the reform measure makes them have more incentive to loosen the rating standards, makes the ratings even less informative. So we make the argument in the paper that the Chinese style of reform, of kind of a piecemeal reform program, has its advantages, but it also creates a lot of unintended consequences, and it's kind of like 2 steps forward, 1 step back, kind of like the program. So that's kind of like a very quick summary of our paper. I'm sorry, I'm running a little bit over time. So I would like to turn over to my discussant. Thank you.
Thanks a lot, Lee, for keeping it within 15 minutes. That was really insightful. I think you had a great paper. I really enjoyed reading it.
Yeah, it's
Yeah.
coming up, Manish.
Can you see my screen?
Yes.
Yeah. Okay, so he already gave a great presentation. I'm just going to summarize it. So basically in March 2014, China did this no bailout reform. The basic expectation was the market will take over and the yield spreads and ratings will reflect the credit or default risk of the firms going forward. There are 2 major findings in the paper. First is significant higher yields observed in the market for lower rated bonds compared to AAA rated bonds. And they also find that there's a much lower default risk for SOE bonds compared to the non-SOE bonds. The authors also claim that this has happened, that credit rating agencies have loosened credit standard, and they try to give a lot of arguments suggesting that CRAs have actually caved into issuer demand. But I'm not very convinced. I'll do that in the presentation. So let's take a look at the first claim. So basically the first claim is yield spreads will get linked to the default risk. For this to happen, my sense is yield spread by itself does not mean anything. So unless and until yield spreads get connected to the real credit or default risk of the firm, does not mean anything. Even with all the state guaranteed bonds before 2014, you still observe some amount of yield spread in the market. So what they are reflecting is something which we don't know. If you are completely guaranteed by the state, then yield spread should technically be 0. But this is not the case, even before 2014. So if you want to actually match or link yield spread to a reference, then that reference is actually credit or default risk of the firm. And I think somewhere, in my opinion, authors must create some what additional information which is available in the market. My sense is these are like top 100 firms in China, and I'm very sure that some of them or majority of them will be listed. And there has to be additional information available in terms of what is the cost of raising capital, or if they're listed in foreign markets or other places, or if they've issued foreign currency debt or things like that. Is there any alternate measure to figure out the cost of capital for these firms? And can this be linked back to the yield spread which we observe in the market? The second observation, which you also pointed out in the presentation, that after the reform, the spread between government rated securities, government bonds, and AAA rated securities, corporate bonds have reduced. I'm not sure why this is happening, but this is an interesting observation. And I think you should explain a little bit in detail as to why you observe this. I also think that your data has time series dimension, and somehow you are not using that dimension. So even a basic event study where I see how the yield spreads have changed over time will be a good starting point to think about the time series dimension of this. The second concern is what happens when credit rating agencies up or lower their standards and how investors respond to this. In my opinion, ratings are just symbols. In different countries, there are different grades. In India, we have like 24 different ratings from bonds. China, there are less number of grades, categories. I think by itself, they are just symbol, they don't matter. What matters is ratings gets reflected in the yield spread or the cost of capital when firms actually go to the market. You have reasonably good data. You have 140 defaults in a year in 2018, 2019. 80% of these bonds are issued by SOE. So this means a couple of SOEs have also failed. I think we can easily calculate default probability for each rating category, and some analysis based on that would have given more evidence in support of your hypothesis. If I look at the evidence which is presented in the paper, you say that 80% of the bonds are issued by SOEs and SOEs have far lower default rate. In my opinion, this actually means that they are issued a higher rating because they are not defaulting. If you're saying that this is actually true, then they should assign a higher rating. Logically, it will follow that they should, going forward, be assigned a higher rating. And this argument, which is CIA, CRAs will succumb to market pressure and they will force, investors will force CRAs to give higher rating. I think this is true across market, even in well-developed market. There are a couple of CRAs which compete for the market share. And this effect will be uniform across firms. So there will always be a slightly upward bias in the ratings of all firms, but they should not treat different firms differently. There's like grade inflation in the problems in education. I think, on average, we should observe a higher upward bias in all credit ratings. The authors also make some claims that young CRAs don't care about reputation, but there's no supporting evidence given in terms of if this is true, then we should see more firms getting rated by younger and younger CRAs. So that kind of evidence would have helped make your case forward. I just try to compare how it looks compared to what we observed in a country like India. So we have a data for the last 12 years and we looked at it. And this is also true. So we don't have default data because government-owned firms haven't defaulted in India. But if I look at the downgrade versus reaffirmation, actually even in a country like India, we see very few downgrade of government-rated firms. We also see very few upgrades in government-owned firms. So it seems like this problem is persistent. It's not just a problem with the Chinese economy. It's also persisting in a country like India where government-owned firms. That brings me to the next question, which is, in that case, I would like to change my motivation to the effect of state versus non-state ownership. It's a question of privatization versus nationalization. As you have documented upfront in your paper, that there's a big bang reforms versus piecemeal reforms, and this forms under a piecemeal reform where step by step you are trying to gradually become market oriented. My concern is if this is not functioning, and I can show my last slide. Basically, if I read Indian history in the late 50s, there was a nice cartoon which came which says public sectors always look better in front of private sector under certain kind of regulations. So when we started this 5-year plan, we had this, and cartoons make fun. I think if this persists, then the evidence is suggesting that SOEs default less, they perform better. Government and non-SOEs fail in numbers and it's not working well for them, government might feel that it's better to have more and more state-owned firms. So even the reform backfires and you basically go, instead of going for more and more privatization, the market access, you go backward. So I think that angle should be pursued. We should also think about what happens. Privatization debate should also be a part of this paper. That's all from my side. Thank you. Thanks a lot. It's a great paper. Best of luck. I hope it gets published in some good journal.
Thanks, Shubham.
Thank you. Thanks, Manish. Thanks, Lee. Lee, would you like to take some time off to respond to Manish's comments, or how would you like to do this?
Yes, that's a very good point with regard to the credit rating evidence. To some extent, you're right. We don't have a strong evidence to support our hypothesis. And if the length of the paper is not limitation, I'm probably going to need to do a lot more on that one. Yeah, you're right. Absolutely right. The second thing you're talking about is something that I'm thinking about doing, is that looking at actual probability and how well the ratings predict default. What happens is that in the past, there's a no default whatsoever. So there's kind of a moot, there's a question moot. But given the data availability, my follow-up study is looking at actually how well the Chinese ratings are predicting default, and look at if there's any different quality differences between many different rating agencies, stuff like that. That's exactly another project that I'm planning to do. Thank you very much. The other point with regard to the young companies and the reputation building, yes, we don't have no evidence whatsoever, but it's kind of like we're making an argument that if you are established rating agencies, you have some the reputation capital to protect, right? Versus if you're a young startup, you don't have reputation to start with. So it's easier for you to sacrifice reputation for short-term gain, right? Come on, I screwed up things and make quick money and file for bankruptcy. What's a big deal, right? Versus I'm an established company. I already have that 50 years of reputation online. I'm not going to sacrifice, that 50 years of reputation. So that's kind of like argument we are trying to make. But yeah, you're right. We don't have like a strong evidence to support that claim. Yeah, you're absolutely right. Thank you.
Okay, floor is open. Anyone with questions about the paper?
I have a question. Hello.
Go for it, Yesha.
I believe that was really, really interesting, and I love the discussion as well. It was a fantastic discussion. So the question I had for you, Lee, is the role of lender monitoring as a way to overcome some of the data deficiencies that are being discussed. So, a key channel for information in the context of, debt in the US, for example, is lender due diligence, lender investigation, as a way to get fairly detailed data, actually sometimes much more detailed than shareholders might get. So I was wondering to what extent in China there is the culture, practice, expertise, capacity amongst the loan departments of the different lending institutions to actually engage in careful lender due diligence as a way of increasing information flows within the credit market?
That is a fantastic question. In my other paper, we actually look at who are the main investors in Chinese bond market. And very similar to the US market, it's an institutional investor dominates the market, very little individual retail investors in the market. And among the institutional investors, most of them are commercial banks. It is the commercial banks that dominate the market. Then we have some insurance companies, some fund managers, money managers, but by far, commercial banks is a dominant player in the bond market. Now, one problem here is that not all commercial banks are private sector banks. a lot of the commercial banks in China are actually state-owned enterprises as well. So then the issue is what incentive for them to really do a good analysis on the credit risk and pricing the bonds correctly, stuff like that. So yeah, that's a good question. The Chinese government are actually letting more international investors to get into the market, into the Chinese financial market. The idea is that they hope is that bring some of those big international foreign money managers to bring more discipline into the market. So hopefully things going to change in the next 10, 15 years. Yeah, that's a very good question. I don't know about India. Are India's most of the financial institutions state-owned or private owned institutions?
Harsh, do you want to take this?
Yeah. 65% of banking and 60% of insurance is government owned.
Only, so it's now 65% of banking, which is public sector. And
60% of insurance.
I thought it was lower for insurance now. 60% of insurance is
60% of life and maybe about 55% of PNC.
Yeah, that would probably be a little bit lower than in China. In China, I'm probably going to say about 70 to 80% public sectors, and that is problematic. That is very problematic. So the Chinese financial system, when you look at size-wise, it's a huge, but in terms of efficiency, it is very backward. It is very problematic, to say the least.
Susan, from a bond investment point of view, pensions are important, and they are 90% government owned. EPFO is about 90%. So
okay. Yeah.
So just, I mean, Indian bonds are held 25% corporate bonds by banks, about 50% by insurers, another 20% by pension.
Okay.
And remaining 5 is riffraff.
How much is NPS in that?
In bond holding, corporate bond, NPS is 6 lakh crore. Very small, very, very small. Maybe like 7-8%.
So we are trying to calculate how much of the bonds, corporate bonds in India are being held across all of these financial institutions, including the multiple pension schemes, systems that we have today. Yeah, but we seem to be very similarly, India and China, in terms of large public sector presence in the formal financial system. Probably we should think about doing a comparison. Manish, you're working on this stuff. Perhaps you can talk to Lee about seeing how well we've done versus China on this issue versus not.
Sure.
Cool. All right. So if there are no other thoughts, comments, then perhaps we can start the next paper. Is that okay? Thanks, Lee. Thanks, Manish.
Thank you very much.
Yeah, thank you for having stayed up to do this talk for us. This has been.
I wish I could be in India now.
No, we wish to, right? So perhaps next year we'll have you here. Thank you so much.
Thank you.
Bye. Thanks, Manish.
Bye.